Fundamental analysis. Introduction to the module. The markets for the 6 frequently traded currencies are mostly open and free. Demand and supply determine exchange rates, and anyone who wants to join or leave the market is free to do so. It is reasonable to assume that market participants buy or sell currencies because it is in their economic interest to do so. Indeed, one must make this assumption. Otherwise, no currency forecasting is possible. This module will introduce you to the broad conditions that likely influence exchange rates. These conditions might be economic, financial, or political. Collectively, these conditions are known as fundamentals. Economic fundamentals. We say mostly open and free because national central banks are also market participants. Through direct transactions in the forex market, the imposition of capital controls, the setting of prohibitive interest rates, or other emergency measures, these bodies can have a sizable impact on forex prices. Furthermore, central banks are not profit-oriented. The objective of their actions is not to earn profits in currencies, but to achieve some other economic or political outcome. Such steps are, therefore, notoriously challenging to predict. Even when forex markets are populated solely by economically self-interested actors, one must bear in mind that their economic interest typically lies outside the forex market. For example, British tourists buy yen because they are interested in enjoying a relaxing holiday in Japan, not because they are eyeing profits in GBP by JPY. American investors buy euros because they pursue investment returns in Germany, not pips in EUR or USD. Hence, forecasting exchange rates involves predicting when conditions arise that will make such decisions likely. Several theories exist to determine what exchange rate ought to prevail. The fair value calculated through such approaches reveal whether currencies are broadly expensive or cheap and enable traders to act accordingly. Purchasing power parity, PPP. According to this theory, the price of a good, the Big Mac, is an example of a reference product favored by economists because its composition is identical everywhere in the world, should be the same in all countries. The law of one price. If, for example, the good is cheaper in Berlin than in Birmingham, then British consumers would buy it in Germany instead. The sales of pounds versus the euro, to make this possible, should drive GBP by EUR down until the product prices are identical. The arguments underlying this theory are persuasive. In practice, however, currencies have demonstrated the ability to distance themselves significantly from their purchasing power parities and to remain there for years at a time. The theory, and the various modified versions of it, are impractical for all but the most tenacious traders. Theory of elasticities. If one ignores the price of any particular good and considers the entire import-export relationship between two countries, then there ought to be some long-term tendency towards equilibrium. If, for example, the UK imports massively from the US, strong demand for dollars relative to the pound ought to drive GBP by USD lower to a point where US goods become prohibitively expensive in the UK. Sadly, evidence of stubborn trade deficits and surpluses tend to undermine this theory too. It appears demand for foreign-made products is less sensitive to price changes, price inelastic, than theorized. When consumers want German luxury cars, California-designed smartphones, or French sparkling wines, they are mostly indifferent to the price. In the short term, at least, demand for products determines forex rates, not vice versa. Modern monetary theories on short-term exchange rate volatility. One additional domestically made product that foreigners might demand is the money itself. Cash and cash-like financial instruments are commodities too. When, for example, domestic incomes are strong and stable, demand for cash, in the form of bank loans or credit card borrowing, ought to be high. the supply of money in the system should rise. If the central bank responds to evidence of growth in the money supply by raising cash interest rates, the demand for cash ought to fall. Monetary considerations like this might explain why exchange rates are seemingly able to ignore their purchasing power parity. Currencies will, indeed, react more swiftly to differences in short-term interest rates or money supply growth than they will to differences in the prices of manufactured products. The mismatch might even be the source of considerable exchange rate volatility. The portfolio balance approach. The portfolio balance approach takes into consideration the demand for all financial assets within a country, not just the demand for the money. If financial assets, stocks, bonds, real estate, etc. have a high yield in one country relative to another, international demand for those assets ought to cause the currency to appreciate until the expected return on investments is the same in both jurisdictions. Synthesis of traditional and modern monetary views. Market participants might buy a currency and sell another for many reasons. They might be attracted by its intrinsic value, like its higher interest rate, or the prospect that it might be in short supply in the future. Alternatively, they might appreciate the things one can buy with it, like consumer goods or high-yielding investments. However, not all of these effects coincide. People might be more willing to give up American bonds than Hollywood movies. Similarly, central banks might not always respond to money supply growth, or money supply growth to rising interest rates, in the same way. In short, forex markets are not bound to reflect fair value over any time horizon that is meaningful for currency traders. Economic indicators. Although exchange rates might not respond to broad economic developments in a timely and appropriate manner, they do tend to react to data releases concerning these developments. Currency trading service providers make available a calendar of economic data releases. Although it might be impossible to take advantage of the price changes that immediately follow these data publications, it is prudent to consider them when planning entries, exits and stops. The Gross National Product, GNP. The gross national product is the sum of all goods and services produced by a country, whether that production takes place at home or abroad. The gross domestic product, GDP. The gross domestic product is the sum of all goods and services produced within a country, whether those producers are domestic or foreign. Market participants are more interested in GDP than GNP. In the US, though, the government imposes taxes on its citizens wherever they are in the world, so GNP is understandably a more appropriate measure. Consumption spending. Consumers' ability and willingness to indulge in discretionary spending is an indirect measure of how they perceive their economic security. Investment spending. Investment spending measures business outgoings on fixed capital equipment and the building up of inventories. It indirectly reflects business confidence. Government spending. Governments spend vast sums of money and so have an outsized influence on economic outcomes. Industrial production. Industrial production is the total output of a country's factories, mines, and other industrial sites. In most rich countries, services rather than industrial production make up the bulk of GDP. Yet, this figure remains a useful comparative indicator for the currency markets. Capacity utilization. Capacity utilization is a measure of industrial output as a proportion of industrial capacity. Low levels of capacity utilization indicate slack in the economy or obsolete plant and equipment. High levels of capacity utilization suggest production bottlenecks, high prices, generalized inflation, or even higher interest rates. Factory orders. Factory orders are the sum of durable, products whose lifespan is more than 3 years, and non-durable goods, products whose lifespan is less than 3 years, ordered, but not yet delivered. Durable goods orders. Durable goods include products like cars, white kitchen appliances, and office equipment. It also includes military hardware. So, to avoid the rare order for an aircraft carrier distorting the number, defense spending is listed separately. Durable goods, whether for households or businesses, tend to be expensive. Hence, financial markets treat a high value of orders as a positive sign for the economy. Construction indicators. The non-service sector in rich countries typically accounts for no more than a third of the economy. Yet, within that third, construction spending is a significant economic driver. The data for the U.S. economy, in particular, command much global attention because of the link to wages, consumer confidence and interest rates. The monthly numbers for housing starts, home sales and construction spending will invariably appear in traders' calendars. Inflation indicators. Estimating the rate of inflation is essential for two principal reasons: making international comparisons of economic performance, anticipating the action of central banks. The central banks that issue all the 6 most frequently traded currencies have an inflation mandate. At least one of their tasks is to maintain the level of domestic inflation at an acceptable level. Evidence of inflation significantly above or below the mandated level might be a precursor to a change in interest rates. Traders use GDP data to judge relative economic performance. However, any reported growth in the money value of domestic output could be due to increased production or just to higher prices. To strip out the effect of price rises, economists deflate the number using an inflation estimate. This operation permits valid year-on-year and country-by-country comparisons. Producer Price Index, PPI. The Producer Price Index attempts to measure inflation in wholesale prices. It examines price changes to a basket of goods that represent the inputs to manufacturing, mining and agricultural processes. These goods include items like food and fuel. Consumer Price Index, CPI. The Consumer Price Index attempts to measure inflation in retail prices by calculating the cost of a basket of goods and services consumed by a typical household. This basket, too, includes manufactured goods, food and fuel. But it also reflects other sizable consumer outgoings, like housing and healthcare. Gross National Product Implicit Deflator. The Gross National Product Implicit Deflator is an inflation measure derived from a comparison of current prices with those in a specific base year. The concept of a base period is common in economic analysis, especially for looking at inflation. For instance, one might consider the price of a new car today and its price 10 years ago in today's money. The relative difference between those two values is the deflator. Gross Domestic Product Implicit Deflator. The Gross Domestic Product Implicit Deflator is identical to that of the GNP deflator. This implied inflation adjustment allows economists to distinguish between changes in the money value of GDP, the nominal value, and the change without the effect of inflation, the real value. Personal income. Personal income refers to all income, salaries, bonuses, interest, dividends, rental income, social security benefits, pension contributions, etc., received by households. Financial and socio-political factors. When economic incentives are present, economic actors tend to behave predictably. Yet, there are occasions when the predicted behaviors contradict the social or political goals of governments and central banks. For example, A country faces labor shortages, and the government fears a loss of competitivity from excessive wage growth, but it is hostile to immigration. A country faces high inflation, but an interest rate hike might drive the currency higher and widen the trade deficit the government promised to reduce. The government promised not to raise taxes, but, as the country is part of a monetary union, tax policy is the only tool available to combat high inflation. A country wants to maintain the external value of its currency through direct intervention, but this means selling its reserves of foreign currency, of which it only has a limited quantity. A country already faces a housing bubble, but the government wants to deliver on a promise of homeownership for low-income households by loosening lending criteria. There is a saying in the market: that which is unsustainable will not be sustained. Whenever actions by authorities seem to run counter to the fundamentals, traders must ask themselves whether they are sustainable. The realization, sometimes sudden, that some measures are not, is the cause of much market volatility. Summary: fundamentals reflect the collective impact of the independent decisions of billions of consumers, firms and investors, acting in their self-interest, all around the world. Fundamentals are undeniable. Economic actors respond to international differences in interest rates, investment yields, prices for products, inflation rates, real growth rates,